Is it time to buy or sell C stock? I personally own a stake in C, and now it's down about 30% in just the last few days, and it's been an absolutely wild ride. At first, I bought the stock a few years ago. At one point at the end of last year, the stock was up over 1,000%, and I called out to my subscribers. I said, look, this was previously effectively a teaser position for me. When I bought it around 2019, I made it like a 1% position, and then it like 10x'd, a little more than that, over the ensuing years, became like around a little under 10, around 10% of my portfolio ballpark. And at that point I said, wait a second, do I really want this to be such a large part, of my portfolio? Looking at the valuations, and I've called this out previously, like, wait a second, you have a business model that needs to prove itself out. You're getting a full valuation. This is the reason why it's so important to size up business quality as well as valuation. So we're saying, what can I pencil out in terms of risk reward in terms of the years ahead? It's important. It's always important to focus on quality. Is this business unrivaled? But you also need to say, hey, am I paying a reasonable price for it? And when I saw, last year, things had gotten a little rich, I called out to my subscribers. I said, you know what? I might be an idiot here. I said this to them. I said, I might be an idiot here, but I just have to sell C stock because it just strikes me as too rich. Since then, obviously, the stock is down quite a bit, from over $300 a share, now, around $67 a share. What's going on? Well, let's talk about their latest earnings results, their second quarter results. You really have three different segments here. Looking at C, you have their e-commerce business, which continues to take share, is performing very reasonably, I'd argue, in terms of top line, looking at 50% plus growth. Their digital entertainment business, this is a concern here, where you see their bookings down around 40%. Now, their digital financial services business, this is just on fire, in fuego, and this is really sort of a venture bet. We'll talk more about that in a second. Now, the reason why the digital entertainment segment, or Garena, is down so much is, and this is really a challenge for C, because you're looking at a business that this segment, their Free Fire business within their digital entertainment segment, generates all of their profitability. You see total adjusted EBITDA. This dark blue is digital entertainment. Everything else represents huge losses, like $700, $800 million negative EBITDA from their e-commerce, from their digital financial solutions. So this is a real challenge to say, oh yeah, our bookings for the only profitable segment is down 40% year over year. So our profitability is obviously going down. And that is the only thing sort of helping them manage their cash flows, because you look at their cash flows and holy cow, this cash is a cash burning company. Last year in the comparable period, you effectively saw, sizable cash burn, net change in cash of $1 billion. Now you're looking at the first 6 months of this year, change in cash of around $3 billion. You could see operating cash flow, negative $1 billion, negative $2 billion in investing activities. I'd like it if they broke it out a little clearer in terms of capital expenditures versus OPEX, or versus, operating cash flows. And so you see this, and you see that they have around $7-8 billion in cash, and you're like, okay, this business is burning a ton of cash flow. This is it's just throw it in the incinerator to drive growth. And so you have a couple $1 billion cash burn potentially every year, $2 to $3 billion. Maybe they get that under control, and you have $8 billion in cash. So you're saying, okay, so what's my runway for this? But I'd argue it gets even worse. So you're thinking about a couple of years potential runway, unless they really, start cracking down on expenses. It gets worse because their convertible debt, which is no longer really the shareholder, the convertible bondholders aren't going to be looking to convert because the stock price is down so significantly. They're going to want to get repaid. And you're talking about $4 billion in debt that's going to be due sometime between 2025 and 2026. So if capital markets remain sort of challenging and C stock doesn't significantly increase, you're going to look at a lot of cash that the company's going to need to put up, unless the capital markets open up and they can easily refinance that. But if they can't, that is an existential threat to C, saying, hey, you have $7-8 billion in cash, you're burning $2 to $3 billion a year. So that means by 2025, you might only have, let's say, a couple billion in cash on hand, and then you're going to have to pay $1.1 billion. Will you be good for that? What about the 2026 convertible bonds? Will you be good for that? And so you're starting to have a balance sheet risk enter the equation when folks think about the equity. And that could mean, potentially a really really wild ride from here. If folks start thinking about the potential solvency of this business, solvency, even if it's a 0.1% risk or 1% risk, because it means effectively a wipeout for the equity in that scenario, meaning shareholders get that creates dramatic volatility for a stock. Because whenever you do like, okay, let's do a probability assessment, 99% chance that this works out, but 1% chance it's zero, that takes a 50% haircut to the stock valuation. And so that's the challenge here. And I think that's starting to get baked into the price, and you will see continued volatility. So management's responding to it, and got to give management a lot of credit here, saying, hey, oh, okay, this is a challenge. We need to focus more on self-sufficiency, long-term profitability. Now they're talking about we're suspending the full year guidance of Shopee. That's another way of saying, yeah, so we're not going to be growing as fast because we're burning too much cash. So we're going to be pulling back on our sales, on our marketing initiatives. And so because we need to survive long term, we need to focus on the marathon that we're playing. This isn't just a sprint to grow, X% over the next year. We need to think, how do we not die? And so if we're going to focus on not dying here, that means we got to get to profitability, and that might mean slower growth because we're going to be spending less on marketing initiatives, focusing on improving efficiency by both deepening monetization and optimizing our cost structure. That means charging their merchants that sell on their platforms more. So the question is, where does Sea stock go from here? It's certainly been quite a wild ride. If you're looking for compelling investment ideas or want to take charge of your investment journey, consider unrivaledinvesting.com for lots of very interesting ideas. And full disclosure, this is not financial advice. So looking at their various different businesses, their e-commerce segment, I personally believe, is unrivaled. You look at the data that they provide saying, hey, we have the most average monthly active users, the total time spent in the app in Southeast Asia, Indonesia, and Taiwan. I mean, Shopee is extremely popular. This is number one by market share, number one by volume. And when you have marketplace dynamics, generally the bigger you are, the easier it is for you to win, because merchants and customers say, why do I want to go to this second tier, marketplace that might be owned by Alibaba, and I own stock in Alibaba as well, where it's sort of saying, well, the second tier marketplace, there aren't as many deals, or the deals aren't as good. Let me go to that primary one. So that's part of the reason the big players just keep on winning. And so this is a really important point, saying, hey, we're the number one player. And they're also, you see it in their results. You see it in the strength of their figures. You look at e-commerce, you see their gross orders up 40%. You see their GMV up around 30%. More critically, the figure I focus on when it comes to Shopee, thinking about Sea stock, is their marketplace revenue, because that is the high margin business. When they do effectively in their e-commerce segment, they effectively break it out between marketplace and direct sales. Direct sales means they take their own inventory and they're selling it. That is razor thin profitability. So I generally don't focus on that too much. I put very low valuation. What I'm focused on is the marketplace, because that business, if you at least look at like what Alibaba did historically with Taobao, Tmall, with 30, 40, 50% profit margins, marketplace businesses where you're not taking the inventory can be very lucrative. They were using their own inventory for a subset of the business, sort of to plug in any sort of gaps in terms of their total e-commerce solution, but looking at what's marketplace doing. And so this is very attractive, seeing that it's up 62%, in excess of both their GMV and gross orders, meaning they're charging their merchants more and they're heading in the right direction. Now, digital entertainment, looking at, what's going on with Free Fire, that is a little bit of a concern. The quarterly paying users down 40%. Management saying, hey, maybe this is a sign of stability, as quarterly active users was actually up over the first quarter. Now, paying active users, paying quarterly users was not, went from 61 million to 56 million users from first quarter to second quarter. So this is a big question mark, in terms of what's the future value, that their digital entertainment segment, Garena, contributes to Sea. Because if it sort of continues this march lower, and this is any insights on Free Fire, if you have some insights saying, oh man, this game is going to be around for years and years and years because people love sort of the tournament style, last man standing gameplay, or they're going to get disrupted. I'd absolutely love to hear your thoughts. Personally, I think it's important to have a range of possibilities as you consider, what does this mean for the stock? And we'll talk about that in just a second. And so the last key component is their Sea Money business or digital financial services. That business really is a venture bet because it's hugely unprofitable. It has like negative, 40%, margins. It's hugely unprofitable, but it is growing at hyper speed, over 50% growth in the active users. There's obviously huge opportunity for financial services in Southeast Asia. So this is like a venture bet within Sea, with their revenues growing over 200%. It is very exciting. How do we think about Sea in terms of valuation? This is something that's really important. A lot of folks miss it because they just use the diluted figure from the financials. You got to adjust the diluted shares outstanding based on their share options and restricted stock. The short answer, and I've talked about this before with my Unrivaled Investing subscribers, is that when you have a company that's unprofitable, because of basic accounting treatments for unprofitable companies, they don't include, let's say, all the dilution. The dilution is real though, and so you do need to factor it in. They call it anti-dilutive. So the super, you need to pull out that magnifying glass and look through the financials and say, okay, where's the anti-dilutive, or I guess modern days, hit that Control F key and look at it and sort of say, hey, where's this extra dilution I need to be mindful of? Because the reality is Sea at $67 a share is over $40 billion market cap. That's not what you'll necessarily see with, all sorts of various different, financial outlets or YouTube channels. And so over $40 billion market cap. Thinking about this valuation, looking at, let's say, their digital entertainment. Let's just focus on, their digital entertainment segment, because this could give you a good perspective. And this is a hypothetical framework. Stock price can go way higher, way lower, but I just want to think about, what it is from here. So thinking about their digital entertainment segment, clearly down a lot this year. I'm penciling out down 40 to 45% this year in terms of their bookings. It is historically very lucrative, around 50% profitability from this. So I'm thinking about that. And then the question is, well, how does it sort of shake out from here? On the low side, I'm sort of saying, hey, it continues to dry up at 5% a year. On the upside, it continues to grow at 5% a year. This is a small range, but really what I apply the wide range of uncertainty is with the multiple, because it's just not clear to me that Free Fire is going to be extremely popular 5 years from now. So in my low case, I'm sort of discounting this very heavily, saying, let's assume only a 5 times multiple. So this is, that we think this digital entertainment segment's only worth a couple $1 billion. This might be way overly conservative. In my more reasonable scenario, I'd say, hey, this business potentially worth, let's say 10 times, once again, baking in a lot of the uncertainty, saying this segment, thinking about their digital entertainment, that's around $15 billion, primarily Free Fire. So what's that imply for their remaining business, talking about Shopee and their digital financial services, Sea Money? So that implies, effectively a remaining valuation of, let's say, $25 billion to a little under $40 billion, assuming, this sort of range of valuation for their digital entertainment. And so that implies, based on sort of my own assumed growth for, Shopee and financial services, of around 3 to 4 times sales. Now, this is kind of interesting to me. I look at this and I'm thinking that marketplace business could be extremely lucrative in the future, but they are certainly, Sea is going through a trial by fire right now. Can they successfully manage this business, pulling down their operating costs, raising their fees, and managing their cash flows? And what does that business look like? Because their growth profile can be significantly lower if they're now operating at, let's say, sustainable free cash flow. So that is something I want to see. I personally own Sea stock. I'm not necessarily looking to go all in on it at this point. I think I think it has, and I have since I sold the bulk of my stock, in Sea, last year when it was up significantly, I have bought dribs and drabs on the way down. I'm not looking personally, and this is not advice, I'm personally not looking to make it a big bet yet. There's a few things that I want to see. And this is partly because this trial by fire with this cash balance, that is a real risk of like, hey, 7-8 billion in cash burning 2 to 3 billion at least a year. And you have 4 billion due by 2025, 2026. So like, hey, how are you going to do that? So I do think, as I own it, because clearly I own it, so I think, I clearly think there is upside potential, or it's worthwhile to own for me personally. And so that's why, I think looking at these figures, thinking about 2 to 4 times, 3 to 4 times sales multiple, what the profit margins on their e-commerce business could look like, that maybe there's, it's either flat over the next 5 years or it's up 200%. That's sort of how I'm ballparking it currently. But I'm not going all in, at the current price, even though it wouldn't surprise me if the stock price, rips higher just because it's sold off so significantly. Also wouldn't surprise me to see it down 50% from here. And that's part of the challenge with this setup, business with, high cash burn. This is the part that I think a lot of investors get wrong, is they think like, well, high risk means high reward, Daniel. No, folks, that's not actually how it works. Look at Warren Buffett. He made billions of dollars. He became one of the wealthiest people in the world by going low risk is high reward. And that's what I'm personally looking for with my own investments at this point, saying what's the high reward, lower risk situations, because those are the types of plays that I feel more confident putting, let's say, 5 to 10% or 20% of my personal portfolio in, saying, hey, I feel like the risk is mitigated significantly with this. You're either buying at a cheap multiple to free cash flow, or you're buying it below liquidation value, or buying it below book value. And you're saying, hey, I've got my arse covered, so I think there's upside from here if they execute, and they have the history of executing. So that's what I want to do for my own personal portfolio. But I also will hold sort of teaser positions, much like how I personally bought Sea, in 2019, around 2019, and made it a 1% position. And it was great. It went to like 10% of my portfolio. So yes, it's okay to have both in your portfolio. And that's why I sort of have this sort of barbell approach of like, I have some bigger positions and things where I'm like, yes, seems cheap, seems likely to work out. That sort of Warren Buffett thinking about, hey, is this safe and high reward? But then I also have smaller positions like Sea, where I'm sort of saying, this is going to be a heck of a wild ride. I better, buckle up, because there's a lot of volatility here. I like that it's unrivaled, but this cash burn, this is a real deal. So I look at their revenue growth, clearly unrivaled, clearly taking share. It is going to be a bumpy ride, folks. So you better buckle up. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing. By the way, I will have a more detailed valuation sheet on Sea for the Unrivaled Investing subscribers. Yet another incentive to sign up at unrivaledinvesting.com. Thanks so much for watching.